First, let's talk about why you need credit. You're going to need credit for a lot of things that hopefully you plan on doing in life, whether it's having a car, buying a house, even just renting an apartment, or even just buying furniture. There's a lot of things that having credit established can help you with as far as building trust with who you're going to be borrowing the money from. When it comes to a house or a car, there's other important factors that your credit is going to impact. And that's going to impact the rate that you get on the loan that you're taking out, and also the down payment that you have to make. So for example, you could be getting the same car, whether you have decent credit or great credit, and based off your credit, not even the car, you're going to be paying more for that same car if your credit is just good versus being great. And it's the same thing with the house. And then the other thing is, when you go to put the money down for either of these items, if your credit score is bad, you're gonna have to put a lot more money up front because they're not gonna let you borrow as much, and they just have a little bit stricter standards for what you need to do to show that you're trying to borrow this money. So having good credit is really gonna impact the amount you have to put down and the interest rate that you're getting on anything that you want. And if you plan on buying a house or renting an apartment or buying a car, literally anything that a lot of people plan on doing, it's much better to get started now with this than later, as it takes a lot of time to establish your credit and get it to the point where you're gonna want it in order to start doing these things. Let's talk about the first thing that goes into calculating your credit score. So the biggest factor is your payment history. This makes up about 35% of your overall score. And what gets included in this is sometimes miffed about, but the main accounts that are going to be focused in this are going to be any credit cards you have open, any auto loans you have open, student loans, mortgages. A lot of your reoccurring monthly payments that you owe money on are going to be factored into this. What's not included in this is going to be your utility bills or your phone bill or things of that nature that could just be gone next month if you stop using them. Items like that just don't get factored in. What you want to focus on is paying your accounts on time. So that's what they care about. If you only have one loan, let's say you have an auto loan and you've had it for 5 months, you've paid it 5 months in a row on time, you're 5 for 5. Your payment history is 100%. And that's the goal. The goal is to have 100%. But now where they start to ding you is as soon as it starts to fall below that. So the first thing you'll get is going to be at 99% or less, which is, I mean, the 1% drop, that's pretty strict, pretty harsh. And you get the worst criterion according to Credit Karma at anything below 97%. So if you miss that 6th payment, now you're only 5 for 6 and your credit is destroyed. So the tips I have for you are going to be always pay your stuff on time. From this moment moving forward, pay everything on time. And on top of that, it could help you to get a lot more accounts to factor into this, right? Because if you only have 5 accounts or 5 payments so far, and then the 6th one is going to have that huge impact, it would be a lot easier if you have a couple more lines of credit open to factor into this in order to build your score up. So let's say you do have a car, you do have student loans, you have a mortgage, and you have 3 credit cards. At that point, you have 5 to 6 different accounts that are just factoring in for you. And every month that you pay those on time, you now have 6 new on-time payments as opposed to just the one that we had talked about earlier. So adding accounts can definitely help you build a stronger credit history. And if you're not already paying on time, make sure you start doing that, because this is 35% of your overall score. The second largest factor that goes into your credit score, and this accounts for 30% of your overall score, is going to be your credit utilization and the amounts that you use of your credit. So what that comes down to is, if you have a credit card with, say, a limit of $500, if you're using $400 of the credit available to you and keeping that balance, you're using 80% of your overall credit. And that's going to hurt you a lot worse rather than say if you spent $400 on your credit card and you have a $10,000 limit, because now it's only 4% of your overall limit. The percent of your limit matters more than the actual amount that you're spending. I know that's not intuitive, but it all comes down to the percentages. So the things that you can do to help with this are going to be, one, try to get your credit limits increased. That way, anything that you are spending on your credit card makes a lesser impact on your overall credit health. And then the second thing that you can do, and this is totally in your control, is pay down your balances. When you are paying down the balance on your credit cards, that's going to help you a ton with keeping that percentage lower. So you have offense and defense here. On the offense, you can make sure that you're paying down your balances and you're making sure that you're making the calls you need to and making the requests you need to have your credit limits increased. And then on the defense, just try not to spend too much and use your credit cards too much to the point that you're even building up these balances to begin with. So 30% of your overall score is going to be your credit utilization, and that's something to definitely keep in mind as you move forward. Another factor that's going to go into your credit score, making up around 10 to 15%, and it's not totally intuitive, is going to be having a healthy mix of accounts and the number of accounts you have. Believe it or not, lenders want to see that you've had 20 plus accounts to make it into this upper echelon for this factor. They want to know that you have history with all different types of loans and are good at paying back all different types of things. You would think that it'd be better to have only a few accounts so that you're not spending as much money and not borrowing as much money. But what they really want to see is just healthy history. So the lowest echelon starts at 0 to 5 accounts. If you have less than 5 accounts, you're actually going to be having this counted against you. And I know that's not intuitive. The types of accounts that you're going to want to build up and to have that healthier mix is you're going to want to have a couple different credit cards, whether they're bank issued, retail, from gas stations. There's also going to be your student loans, your auto loans, and any type of mortgages that you have. Now, I'm not telling you to go out and get student loans or to go out and borrow a ton of money to buy a car or go buy a house you don't need, but rather keep in mind that having these accounts open are going to help you, and the different mixes and different histories that you can get to factor into your score are going to be super helpful. Another factor that goes into your credit score is the amount of recent inquiries you've had and the amount of new accounts that you've opened. An inquiry is whenever you ask a creditor to provide you with money. Now, there's two types of inquiries. There's soft inquiries, which don't affect your credit score, and then there's hard inquiries, which will stay on your credit score for up to 2 years. With that being said, it's not a huge part of your score. These only make up 10% of your overall score. The target for these is to have 0 hard inquiries when you go to apply for new credit, but there's going to be times where you need to apply for credit and you're going to have a couple, and that's not a big deal. Where it becomes a problem is anywhere as soon as you get over 9 inquiries, that's when they start dinging you the hardest. So keep that in mind when you are out shopping for credit, that it's going to affect your score in the future if you're shopping all over the place and asking a bunch of different people a bunch of different things. When you are shopping for mortgages, however, they group all of your shopping into one window. That way you're protected to shop around for the best rate, and lenders can't bully you into taking the first rate that you hear. Why do lenders care that you've been shopping around and making inquiries at different places? Well, this makes a deal to them because they see that you're looking for more money, and if you have a lot of new accounts, they may think that you're in financial trouble and are just looking to go wherever you can to get yourself out of it. It's to protect themselves, and that's why it's important to try to keep only a few inquiries under your belt if you need to have them at all before you apply for new credit. The last factor we're going to talk about today is going to make up about 15% of your overall score, and that's going to be the age of your accounts. Lenders want to see that you have an average, keep this in mind, average of 9 years or more of open history on accounts. they start to ding you, and the worst tier that you can be in is 2 years or less of average age. And I know what you're thinking. If you're anything like me and you like to get things done faster and really have control over them, 2 years is a long time to wait to even get out of that lowest tier. And to get to 9 years seems like an eternity. Well, don't worry about this one because it's not really something you can control other than trying to get started with your accounts as soon as you possibly can. So if you're a lot younger right now or don't have many accounts open, just opening up a couple accounts and not necessarily even really using them can help you establish that average age length of your account. So it's really important that you don't stress over this one and you just do the few things that you can that are in your control to build up your history here and just have some accounts open and let them age. Let's talk about some of the myths that go into your credit score, or rather that don't go into your credit score. People have asked me, is having a lot of different credit cards a bad thing? As we discussed earlier, the more accounts that you have, the better this is for you. Another common myth is that carrying a zero balance is bad for you on your credit cards. That's not a myth. That actually holds some weight to it. The reason that is if you carry a zero balance for long enough, the person who services your credit there may stop reporting that card altogether. So it may just stop factoring into your payment history, so it doesn't help you. But even worse, they may close down your account if you don't use it for long enough. So while it's not bad to carry a zero balance, that's actually totally fine, but not using your card at all for a long enough time could hurt you as time goes on. If they close out your account, the reason that hurts you is your credit limit that you had on that card stops factoring into your credit utilization. So let's say you had a card open that had a $1,000 limit. As soon as they close that down, your $1,000 that you were getting credit for not using is now wiped off the table. So make sure to use your cards periodically. It doesn't have to be all the time. I know I have a card that's been open for 3 years and they haven't closed it down, but that's just that one case. And I would say try to use your card every few months just to keep it active and to keep that factoring into your credit score. Another common myth is that you get credit for your utilities or your phone bill. These things don't really factor in, and they can if you need them to by using Experian Boost. That's really how they boost your credit score instantly, is they try to factor in those payments for you if they can. The problem with this is it's not going to help you at all unless you have bad payment history. If you do have a really bad track record of payment history, trying to get these to factor in will be great, but otherwise you're not going to be able to boost your score instantly, and you're going to just have to take some time and work on paying down your credit cards to get your score up. Thank you so much for watching this video, and I wish you the best with building your credit and establishing a great credit score. Make sure that you karate chop the like button and poke the subscribe button real hard. I appreciate you tuning in, and if you have any further questions on credit, feel free to reach out to me. I'm more than happy to help you. I also have a buddy who's coming out with a ton of videos on credit cards, which ones to get, everything you need to know about credit basically. And at some point, once that's all ready, I'm gonna link that in the description. But for now, thanks again, and I'll see you next week on Financial Freedom Weekly.